Welcome to the world of taxes, where numbers and paperwork collide to create a system that can seem daunting and confusing. But don't let that fool you. Understanding taxes is not only crucial for staying compliant with the law, but it's also an opportunity to keep more of your hard-earned money in your pocket. In this video, we'll demystify the tax system and break down all you need to know about taxes, from understanding tax credits and deductions, to filing your taxes and avoiding common mistakes. So buckle up, grab a pen and paper, and let's get started on your journey to understanding taxes. We'll start by familiarizing ourselves with some common tax terms. By the end of this first part, you'll have a crystal clear understanding of how the tax system works. Taxes are payments made to the government in exchange for the services and protections it provides. Some of the most common types of taxes are income tax. This is a tax on an individual's or a business's earnings, calculated based on the amount of income earned. Sales tax. This is a tax on the sale of goods and services. It's usually a percentage of the sale price, and it's added to the price of the item at the point of sale. Property tax. This is a tax on the value of a person's property, such as their home or land. It's usually calculated based on the assessed value of the property and is levied annually. Estate tax. This is a tax on the transfer of wealth from one person to another at death. It applies to the value of an individual's estate, including real estate, stocks, and other assets. For example, if an individual's estate is valued at $5 million and the estate tax rate is 40%, their heirs would owe $2 million in estate tax. Excise tax. This is a tax on specific goods or activities, such as gasoline, tobacco, and alcohol. The tax is usually a set amount per unit of the product, rather than a percentage of the price. What is taxable income? Imagine you've just started a new job and are excited to receive your first paycheck. But wait, did you know that not all of your earned income may be subject to taxes? That's right. Think of your total earned income as a big pie, and taxable income is a smaller slice of that pie. The slice gets smaller because the tax laws and regulations allow for deductions and adjustments to be made. So, even though you may have earned a certain amount of money, your taxable income could be less once these factors are taken into consideration. What are deductions? A deduction is a type of expense that you can subtract from your total earned income. This means that by claiming deductions, you're lowering the amount of money the government takes from you in taxes. Now, there are two ways to claim deductions: standard or itemized deduction. The itemized route requires documentation and proof of each expense, while the standard deduction is a fixed amount set by the government that you can claim without having to itemize. The choice between the two depends on which option results in a lower taxable income for you. You might wonder why government allows deductions. The purpose of itemized deductions is fourfold. It is to ease the burden of catastrophic expenditures that affect someone's ability to pay tax, to encourage certain types of activities such as homeownership and charitable contributions, to ease the burden of taxes paid to state and local governments, and to allow taxpayers to deduct the cost of legitimate business expenses. Let's take a look at some common itemized deductions you might be eligible for. Charitable donations, medical and dental expenses, home office expenses, state and local taxes, mortgage interest, retirement plan contributions, job search expenses, education expenses, casualty and theft losses. What are tax credits? A tax credit is a powerful tool to help lower the amount of taxes you owe. Think of it like a coupon that you can use at the store to save money on your purchase. Just like a coupon, a tax credit gives you a dollar-for-dollar reduction in your taxes owed. So, if you have a $1,000 tax credit, your taxes owed will be reduced by $1,000. So what's the difference between deductions and tax credits? Deductions can reduce the amount of your income before you calculate the tax you owe. Credits can reduce the amount of tax you owe or increase your tax refund. Certain credits may give you a refund even if you don't owe any tax. To summarize, you start with your total income amount. Then you subtract from it all the eligible deductions to arrive at taxable income. Once you have your taxable income, you can then use the tax brackets and rates to determine how much you owe in taxes. From this tax amount you owe, you can then subtract dollar for tax credits you claim based on your eligibility. So tax credits will subtract dollar amount from actual tax you owe, while deductions reduce your taxable income before taxes are calculated. The United States uses a progressive tax system, which means that the more you earn, the higher your tax rate. Tax credits can be based on things like the cost of education, caring for a child or dependent, and even adoption expenses. Some tax credits are non-refundable, meaning they can only reduce your tax liability to zero, but cannot result in a refund. Other tax credits, however, are refundable, which means you can receive a refund from the government even if you don't owe any taxes. Some examples of tax credits are: child tax credit is for individuals who have dependents under the age of 17. Earned income tax credit is for low to moderate income taxpayers who work. American Opportunity Tax Credit is for higher education expenses such as tuition, fees, and course materials. Lifetime Learning Credit is for education expenses for an unlimited number of years of post-secondary education or courses to improve job skills. Adoption Tax Credit is for expenses related to the adoption of a child. Child and Dependent Care Tax Credit is for expenses incurred while caring for a qualifying child or dependent to enable the taxpayer to work or look for work. Energy Tax Credits is for making energy-efficient improvements to your home, such as installing insulation, solar panels, or buying energy-efficient appliances. Electric Vehicle Tax Credit for buying new, qualified plug-in electric vehicle or fuel cell electric vehicle. Please consult tax professional or check IRS website on details regarding eligibility requirements. In the next video, we'll continue our tax journey and dive into the world of tax mistakes. We'll learn about the different tax forms and what they mean, so you'll have a clear idea of which forms you need to fill out and why. With this knowledge, you'll be able to file your taxes with confidence and ease. Get ready for a fun and informative ride. Thank you for watching the video, and I hope you had an amazing time watching it. Don't miss out on any of the future videos. Press the like button, subscribe to my channel now, and hit the notification bell to stay updated on all of the latest content. Make sure to share it with your friends and family so they too can join in on the fun and learning. Leave a comment below and let me know what you liked about this video and what you'd like to know more about. Your feedback will help create content that is relevant and interesting to you.